So what do these companies and investors all have in common? They were all taken public or were involved in taking a company public via the SPAC. If you've been paying attention to the financial news, you may have seen more and more coverage on this type of investment vehicle, which is known as the Special Purpose Acquisition Company. But what the heck is a SPAC? I had this question too and decided to dive in. What follows is my layman's understanding of what a SPAC is, how it operates, and why it has become such a popular investment vehicle. For those of you that are joining the channel for the first time, my name is Chris Blum. I am a commercial real estate broker in the San Francisco Bay Area, and I make videos on real estate, productivity, personal finance, and investing. So without further ado, let's dive into what a SPAC is. A quick Wikipedia search reveals the following. A special purpose acquisition company, SPAC, sometimes called a blank check company, is a shell company that has no operations but plans to go public with the intention of acquiring or merging with a company utilizing the proceeds of the SPAC's initial public offering. In other words, it is a form of a reverse merger in which a public company acquires a private company to take it public. Now, in some cases, a private company can actually acquire a public company through an asset swap, but this is a little bit controversial and can lead to opening doors for fraud. If this sounds interesting, I would highly recommend watching the China Hustle, which is a documentary that I will link to below that I found fascinating.
A busload of investors shows up. All of a sudden, things get turned on. They leave. All the lights go back off.
It's a $150 million company.
It's a total fraud.
But the SPAC has a few unique advantages for a reverse merger, as you have a clean shell company, access to institutional investors, and a management team that is typically skilled or highly specialized in the industry of the company that you are acquiring. So it is a form of reverse merger, and the process goes something like this. A sponsor, or the person or management team that is going to lead the acquisition, such as Bill Ackman or Chen Chu, which I highlighted in the early moments of this video, will create a shell company and raise initial funds through an IPO. Now, this IPO process is very similar to what a traditional operating company would go through. You still have to register with the SEC and everything has to be in order. The difference is that there are much less financial documents to disclose as there are no operations. And so this process typically only takes about 8 weeks instead of months. Once the funds have been raised, they are held in a trust account until a target company has been found, and then these funds are used to acquire the company. Once the company has been acquired, the SPAC shares are delisted and the investors are given the chance to transition into the new company via warrants that they were given when they bought into the SPAC. So if this all sounds a little complicated, that's okay. Basically, it is a way for investors to invest in a person or a management company that they believe has a special skill in a certain area of the market and give them money to go acquire a company. And this is a little bit unique because unlike investing in the public markets where everyone has access, these tend to be a little bit more like private equity deals. So for the investor, they may get access to knowledge or to deals that they wouldn't otherwise have. Every SPAC is unique, and if you are considering investing in one, you'll typically need to be an accredited investor. You should do your homework and understand what all the rules and governance of your particular special purpose acquisition company are. But in general, they share some common characteristics. The sponsor almost always has a finite amount of time to find a new acquisition target. This is typically 18 to 24 months. If a company is not found within this time, the funds are returned to the investors minus any overhead fees. Also with a SPAC, the target company or even the target industry is not known at the time of the initial public offering for the SPAC. So the investors are essentially trusting the sponsor that they have skills to go find a good company. The company itself is not noted in the prospectus. Most SPACs will give the investors voting rights to approve or deny the acquisition, but some sponsors will have more control over this process. Also, most sponsors are given a promote or an equity stake in the new company for managing the process. And typically, a sponsor will put in 2 to 8% of the initial investment, but receive around 20% of the equity in the new company. And this is done through complex financial contracts. Actually, they're not that complex. It's through warrants and founder shares. But regardless, the sponsors typically have an oversized equity share in the new company relative to the investors that put up the money. So basically the sponsor is saying, you should trust me. I know a lot about this certain sector or this industry. I can go find a good investment that you wouldn't otherwise have access to. And so it is worth it for you to give me some of the proceeds and some of the equity share in that venture. So just how prevalent is the SPAC? In 2014, there were 12 SPAC IPOs raising $1.8 billion. By 2019, this had reached 59 SPAC IPOs for $13.6 billion. And if you take the number of SPAC IPOs and divide it by the total number of IPOs in 2019, you find that it makes up 25% of the IPOs and 21% of the funding. So now that we understand how prevalent the SPAC is in today's market, let's look at each of the parties within the transaction and see under which conditions it makes sense. Starting with the investor. The investor is the one that I personally have the hardest time making a clear-cut case of whether or not it makes sense. Now, under some conditions and under a diversified investment portfolio, I think it could make sense to have some of your investments with a sponsor that you trust and looking for a private equity type deal that could have huge returns, but is also a little riskier. Now, in the case of a SPAC, you are giving the sponsor a huge amount of trust, as you do not know what the company is prior to investing, and you are also giving away a pretty large share of the equity piece in that company that is going to be acquired to the sponsor. So you should really have trust for them and their investing background, and you should also make sure that you understand all of the governance rules and the investment criteria of the SPAC. Now, moving on to the sponsor, I think in most cases it makes a lot of sense. You are able to raise considerable funds, get an equity piece from those funds. There is a promote built in, and you do not even have to wait until a return is realized. You get that promote up front. There are no debt payments, and many sponsors have figured out ways to reduce redemptions. This is one thing I forgot to mention for the benefits for the investor, though, is that because you are investing in the SPAC and it is a publicly traded company before the acquisition, it is a little more liquid than a private equity investment where you may be locked in for 10 years. So you could trade those shares on the public market if you decided that you didn't trust the sponsor or wanted out of the investment. Now, back to the sponsor, it gives you a lot of control. You control a sizable fund and can go to companies with lots of leverage. Now, the downsides are you do have a ticking time window. So companies may realize as you get to the end of your 18 to 24 month period that you should probably be a little more negotiable, or you risk having to give the funds back to the investors and not getting that promote. But for the most case, I think this is a pretty good deal for sponsors, and I can understand why they have become so prevalent as a means of raising funds to go out and do these acquisitions. And finally, the target company. And I think for the target company, it makes a lot of sense in many cases as well. The target company receives a quick and painless way to raise funds and access the public markets without having to go through a lengthy IPO process. As we mentioned earlier in this video, the IPO process can take up to a year, involves a lot of time of management, and involves a lot of scrutiny of the financial documents and business practices of the company. The SPAC comes in and is able to negotiate terms up front. So for the target company, they're not worried about how the public market is going to receive the IPO. And you also avoid a lot of the perverse incentives that are typical in a IPO. So for example, during the normal IPO process, what many do not understand, and I didn't understand when I went to research, is that it is not a market regulated event where buyers are matched with sellers and the price floats for the IPO stock until demand meets supply. Instead, what happens is the investment bank who is chosen gets an allocation of shares that they have to sell, and they typically want to make sure that the IPO is oversubscribed by as much as 30x. So to help understand this, you can imagine a housing market. Now, if you price your home to where you would get 30 offers, the price is probably going to be far below if you priced it to where you might get 1 or 2 offers that you could then go through with a sale. And the other thing is that the investment banks take on average about 7% of the IPO proceeds as their fee. So a study that I will link below found that in 2019, the average IPO was priced 31% below where it traded at the end of the first day. So if you add the 7% cost of doing the IPO paired with the 31% underpricing, that is a lot of equity that the company gives away by doing a typical IPO. Now, some companies like Spotify and Slack are moving to the direct listing, where they go direct to the consumer. You still hire an investment bank to help you put together a prospectus, and you still do a roadshow, but instead of having the investment bank sell the shares to their best investors and try to be oversubscribed, it goes directly to the market, and sellers are matched with buyers, and demand is matched with supply, and the price tends to be much higher. Now, the downside is that a direct listing does not allow new funds to be raised for a company. It only allows existing shareholders, so the founders and early investors, to cash out of their investments, but it does not allow the company to originate new shares to sell funds for the operations of the company, like a regular IPO does. So now comes the third way that a company can go public, the SPAC, which allows for new funds to be raised, it allows for early investors to get an exit, it allows all the terms to be decided up front, and as you can see, is a fairly beneficial way for a target company to go public. Also, as mentioned as a negative in the sponsor section, the target company can use the fact that the SPAC has an end date as a form of negotiation. If they know that the SPAC is nearing the end of its 18 to 24 month timeline, they can push a little bit harder on the negotiations and get better terms. Also, as more and more SPACs flood the market, the terms have tended to normalize and become a little more beneficial for the target company just through competition. Now, the downside is that they may have to give away more control than they otherwise would in terms of board seats and the governance of the company post-IPO. So I hope you found this video interesting, and when someone brings up a SPAC, you will know what it is and why it is becoming more and more prevalent. If you enjoyed this video, consider subscribing for more content and smashing the like button to help the YouTube algorithm. I will leave all of my social media down below, and if I happen to have any finance or Wall Street gurus that are watching this video, I would love to know what I got right, what I may have gotten wrong or missed, and what you think of today's video.